to 170. If you're married, it's a 22% bracket, and 40 to 85,000. It's also a 22% bracket if you're single. The other thing that's going to come up later on is there's a 0% capital gains rate. So if you're in the 12% bracket and all of your income is capital gains and qualified dividends, then that comes in tax-free. So that'll be something that we look at a little bit later. So.
Good. All right, then into recent tax law changes. To kind of help set this up, there's been a lot of legislation in the past couple of years that's impacted both charitable planning and retirement planning. So this is just kind of a snapshot of the acts that we may be referring to. TCJA, Tax Cuts and Jobs Act, 2017. Secure Act, setting every community up for retirement enhancement, that was passed in 2019. And of course the CARES Act, which was passed into law in March of this year. And the IRC means Internal Revenue Code of 1986 as amended. Key changes for planning areas. So in this slide, what we're trying to do is just sort of give you a quick snapshot overview of the changes over here, and then the acts to which those track to. So starting with charitable contributions, which is of course the topic of the day here. In the TCJA is where the significant change was made to allow 60% AGVI deductibility for cash only contributions. Before it was 50%. So the law now is, at least coming into this year, 60% if it's all cash to public charities instead of 50%. Then you have the 2020 changes as a result of the CARES Act, which we'll get into. The 100% AGI deductibility for qualified charitable contributions. Taxable income limitation for corporations is increased to 25% from 10%. The food inventory limitation was raised. Then of course we had the all popular above the line $300 deduction. That's in addition to the standard deduction. The other deductions that were impacted by the TCJA for state and local taxes are capped now at $10,000. So if you have property taxes in addition to income taxes, state income taxes or other taxes that are applicable, somebody may have usually had 25,000, say, in a given year. It's capped at 10,000, and therefore also the standard deduction was doubled in the single and married filing joint case, and that had a big impact on itemizers and then those who were giving to charitable organization and getting the deduction. So that definitely had an impact on the not-for-profit community. Then what they call the P's limitation, the income phase out on itemized deductions, was repealed as well, which was welcomed by most everybody. Perry, you want to talk about the qualified plan?
And so there were also a couple of changes to retirement plans that have come out in the last 2 years. First was the Secure Act, and what that did is it pushed the beginning date for required minimum distributions out of your IRA from 70.5 to 72. You can still take money out anytime you want, but you don't have to take it out until you're 72. And then the other, when the CARES Act came out, I don't know if anybody remembers, the economy as a whole, the market was kind of scattered at that point, and Congress didn't want people to be required to take distributions out of their IRAs at kind of a low point. So what they did is they suspended the requirement to take a distribution out of your IRA during 2020. So inherited, age 70.5, 72, whatever the requirement is that you normally have to take it, you don't have to take them, and that applies to 401k plans as well.
Good. Now, before we kind of get into some of the scenarios and whatnot, I need to sort of set up some of the key definitions out of the Act. So what's extremely important to understand is the definition of a qualified charitable contribution. And that comes into play not only for individuals, but corporations as well. This is defined in Section 2205 of the Act, and essentially provides that a qualified charitable contribution must be donated in 2020, must be in the form of cash only, to a public charity, and the taxpayer makes an election with respect to that contribution to treat it as such, as a qualified charitable contribution. It's also key to know that the definition of public charity in the Act specifically excludes donor advised funds and certain non-operating private foundations. So, that's a key component, which there are some aspects of that are beyond the scope of this presentation. But donor advised funds certainly is something worth looking at here, because I know a lot of people leverage that vehicle. So as I said, the election applies both individuals and corporations. I think there's more guidance to come from the IRS as it relates to that. Public charity defined. We put this here just as a refresher of what, just in simple terms, what public charity is defined in the code. It's most everything you think it is, but then there's some other organizations that are really defined as public charities you may not think of as a public charity. So those are qualifying organizations for purposes of the Act. Now, Perry will hit on some of the provisions impacting individuals first.
And so thinking about what they did, like Eustis mentioned earlier, Congress was concerned that charities were going to be called upon more than ever in a year like we have now, and that there might be kind of a shortfall of funding. So what they tried to do is encourage charitable giving as much as possible, and they took a bookend approach. So normally, if you take a standard deduction, you can't itemize your charitable contributions. But so, kind of similar to the lady that Dr. Morris was talking about when we started, they now have, for those people that are taking the standard deduction, they can deduct up to $300 worth of cash contributions to a qualified charity during the year. And that's $300 per tax return, basically. So if you're single, it's $300. If you are married, filing joint, it's still $300. But so they tried to get, that income side, and then they also looked at the larger givers and increased it up to 100% of adjusted gross income as far as an allowable contribution. So one of the things that we'll look at is, does it make, if you are in the position to give that much, does it make sense to take the deduction this year, or maybe, go and do the gift and then possibly defer some of it for the future? But you've got a lot of flexibility, and I think the key, like Eustis said earlier, is it's an election that you make after year end, so you'll know what the facts are before you have to make it.
Well, one thing I'll add on the $300 deduction, there is a movement within Congress to change that to allow either for a $600 deduction for married filing joint filers, or even increase it. So stay tuned there. It's not moving very fast, but there is a lot of bipartisan support. All right, moving on for the provisions impacting businesses. As you recall from an earlier slide, there's a current limitation on the deduction for charitable contributions by a C corporation of 10% of their taxable income. So, for instance, if you have a C corporation out there with $1 million of taxable income, their limitation is $100,000. So you think about a lot of charitable-minded companies out there who may be given even more than that. It creates a carry forward into future years. That limitation is now lifted to 25% for contributions made in 2020, in this year. What's interesting with this is that the language in the law specifies contributions made in 2020, or for taxable years ending after December 31st, 2019. So fiscal year filers, fiscal year companies with a May year end, a September year end, October year end, are eligible for this for donations made in this year. There's an open question as to whether or not that also applies to them if they made a contribution in 2020, but after that year end. So stay tuned on that. There may be some more guidance that comes out. Food inventory is also a big topic here. Don't have to go too deep into it, but just we'll say common sense will tell you, okay, when the shutdown came, a lot of restaurants closed, a lot of food service companies had a lot of inventory built up in their refrigerators. So in order to avoid spoilage and non-use of that inventory, the food, Congress lifted the limitation for those companies to give, and to hopefully prompt them and incentivize them to give more food into the communities where it could be put to use for the needy. So that's I think that was the purpose behind behind that particular provision. In both cases, just a quick word on partnerships and S corporations. So the partnership and S corporation can make the charitable contribution, and as you know, that flows through to the shareholders or partners on their K1s as a separately stated item. That deduction in that election that we talked about earlier is made at the individual shareholder or partner level, not the business corporate level for those pass-through entities. Just a quick note on that, so that, because I know we have a lot of partnerships in those corporations, a lot of good, closely held companies that are in that form of business here in Memphis that could take advantage of this at that level. So here's just a slide on, talking about the election. Again, there's no mechanism specified for making this election out of the act. We expect guidance from the IRS at some point, maybe later this year. The CARES Act language specifies and references a contribution in singular terms. So what if a single gift is made of $1 million? Does that taxpayer have to make an election with respect to the entire gift, or to deduct the entire $1 million if they can, or can they elect to make a partial election with part of that money and split it? Maybe they give $600 and $400 in two separate checks. We don't know yet how that works out, but there's many scenarios like that it will be playing out between now and year end. So stay tuned on that front. This is a visual of how the limitations can work and be stacked. So when we say stacked, typically you'll have individuals make a donation of capital gain property, stock, plus cash. And that stock and or cash may go to public charities and or private foundations. So therefore you have to work around and work with how those interplay with each other in terms of meeting the limitations and not exceeding the limitations. If you exceed the limitations, then you have a carryover. And in some cases, it becomes hard to use those carryovers in future years, and they expire unused. And that happens more often than not, quite honestly. So it's imperative to be careful about your limitations. In 2019, as Perry mentioned before, coming into 2020, looking at the bar graph on the far left here, this is an example of how somebody might meet the 50% limitation, which is what is in effect. They might give 20%, a 20% type gift, and maybe to a private foundation, capital gain property, and then 10% to public charity, and then 20% in cash, and they can deduct that whole 50%, if you will, in full, or give all cash and get up to 60% of their AGI. So that's just a real simple kind of diagram of what that would look like. Perry, you want to walk us through what it might look like in 2020?
Thanks, Eustis. Yeah, so in 2020, what ends up happening is you've got two options. The first option, you're stacking with appreciated stock or private foundation or whatever else to get you that first 50%. So that's going to be 30% stock gifts generally, 20% in cash. That's where your old limit would be. And then you've got an additional 50% that you can give in cash that you've got the ability to make the election on, and so you can time when that goes in. The other option is if you're just doing straight cash, then the first 60% is definitely deducted this year, and then the next 40%, you've got the ability to select the timing on that gift. And then at this point, 2021 and forward, we go back to the old rules. So, right. This is a one-time deal.
And then in 2026, the 60% of AGI for cattle cash goes away, sunsets at the end of 2025. So, so it's kind of a visual snapshot. Some of this will make sense, a little more sense later when we get into some of the scenarios. So a quick word about our scenarios and how this is all working out. It's imperative that you seek and obtain your professional tax advice, your own professional tax advice, before making any personal tax planning decisions. This is especially true for charitable giving at higher levels of your adjusted gross income, or AGI, or taking distributions from a qualified plan, such as an IRA, for charitable giving. For example, there are some scenarios, especially for taxpayers in higher income tax brackets, where you could reduce your overall taxability by splitting charitable gifts between 2020 and 2021 instead of maximizing gifts in 2020. And of course, there's no certainty about what the tax laws will be in 2021. With that, we're going to launch into 5 scenarios. I think we're doing good on time. This is where the fun starts. So I'll let Barry kind of walk us through a setup on that. Barry?
So the first example we want to do is just kind of some planning that we do with clients, even in years when it's not 2020. We're looking at trying to figure out what's the best way to maximize the tax savings on your charitable contributions. So in this example, we've got somebody, a married couple, they generally donate $40,000 a year to charity. Their taxes for property, state and local taxes are $10,000 or more, so they're capped at $10,000. If they decide to do that $40,000 every year, then over the course of 5 years, they'll give away $200,000, and they'll take itemized deductions of $250,000 over that 5-year period. So one thing that's worth doing is, instead of waiting and doing the contributions over a 5-year period, it's possible to do a lump sum contribution. And then this also plays in to account this year because we don't have to worry about the limits of your adjusted gross income. So in this example, we're going to have the couple give the $200,000 in 2020, and everything's done up front. So the total itemized deductions are $210,000 this year. Going forward, they've already made the contribution, so they won't be able to itemize, which means they'll take the standard deduction of $24,500. Not being able to itemize ends up saving them a significant amount of money, because taking that standard deduction lets them do $24,500 each year. So over that 5-year period, if you front load the gift, the total deductions from your income is going to be $308,000. So an extra $58,000 reduction to your taxable income over the time. So, it's just one of the things that we're looking at and working with clients on is trying to figure out what's the way that we can minimize the tax, because for that allows them really to increase the giving that they're doing each
And
year.
then this really came into play on the heels of TCGA with the higher standard deduction. A lot of people really front loading their deductions into, say, donor advised funds. So this is definitely still very relevant as it relates to what we're talking about today. So scenario 1, what we're going to kind of do here in these is talk about a typical fact scenario, and then the base case tax calculation. So in this first scenario, we have a single filer, somebody's age 35, makes $100,000 a year, but they have a large brokerage account because maybe they're second, third generation person, child in a high net worth family group, or somebody who's working in the family business or working for a foundation. And they give away, typically on any given year, $25,000 in cash, and they are making tax efficient moves with their portfolio and giving $50,000 a year in stock. So if this person did this, their AGI is at 100. Their itemized deductions that they were able to take would otherwise be 75. 25 plus 50 would give you 75,000. Well, because of the 50% limitation, they're limited at 50. So $50,000 is their itemized deductions, which gives them $50,000 taxable income, about $7,000 in tax. And down here, you can see there's a charitable contribution carry forward generated of $25,000. And that the character that attaches to the stock when it's used in a later year. And also worth noting for the next, what Barry's going to walk you through, the unrealized gain with respect to these securities donated is $15,000. All right, Perry, you want to walk them through option A?
And so option A in this case, let's assume that the person wants to go on and take the full deduction this year. It makes sense to. In that case, what they could do is they could sell the $50,000 worth of stock. They'd recognize the capital gain, so they'd have their adjusted gross income goes up by another $15,000. But since they've got cash now to give to the charity instead of cash and stock, they can deduct the full amount of that $75,000 gift. That drops their taxable income down to $40,000. So tax due goes from $6,800 to $2,800. Basically a $4,000 tax savings and kind of a 16% benefit. So what happens there is you get the benefit of using all of the deduction this year, and then next year they take the standard and probably get a better answer.
Very good. Scenario 2. In this scenario, we have a married filing joint couple, age 45, base salary of about $400,000 and interest of $5,000, qualified dividends of $10,000, long-term capital gains of $20,000. Their typical itemized deductions amount to the $10,000 in property taxes, mortgage interest of $10,000, and then they give away $65,000 a year in cash. So on a base case basis, this is what their tax posture looks like, paying about $71,000 in federal tax. And by the way, we're excluding any kind of state income tax or state taxes in these scenarios, just federal tax only. And just it's worth noting that their AGI, where they are, charitable contributions as a percentage of AGI is 15%. So, Perry, tell us what happens next if we.
And so here, let's assume that they've got the ability to make large gifts, and they want to zero out their tax liability for this year. So in this case, we do a mix of appreciated stock and cash to the public charities. That gets their total itemized deductions to $435,000. Their taxable income goes down to zero. The tax due is not a mistake. We've got that there's a net investment income tax that's payable also depending on what your adjusted gross income is. So they look at the top line, and if that number is over $250,000 for a couple or $200,000 for an individual, then you owe an additional amount of tax on the investment income. But what this does is it reduces your other tax down to zero. One thing that they may have done in this, and we'll show it in another example later on, is they may have actually given away $30,000 too much, because remember, up to $80,000 worth of capital gains and qualified dividends is at a 0% tax bracket.
Yeah, so it's important to optimize the amount of charitable contributions you're giving. In this case, it's about a 20% savings rate on the additional amount that we're giving, and they're maxing out on the capital gains property at 30% of their AGI. So you'll see that in a lot of our scenarios. Next one, scenario 3, we have a couple filing jointly, age 60. He's still working at $250,000 a year, interest income of $50,000, a little more qualified dividends, $125,000, and capital gains of $200,000. Mostly really attributable to our large brokerage account that they're maintaining, and we're capped out on taxes, and they're a little more charitable minded. They're giving $100,000 a year in donations. So this is what the tax posture looks like. In the base case, $625,000 in AGI, itemized deductions at $110,000, so taxable income is at $515,000, which throws off a $90,000 tax liability. But it's important to note our charitable contributions as a percentage of AGI is at 16%. So, Barry, what's option A look like for these guys?
And so option A, we're doing similar thing to what we did with the last couple. We're trying to get that taxable income down to zero. So we're using cash for $435,000, $180,000 worth of appreciated stock, and that gets taxable income down to zero. Tax due, once again, because that investment income tax They owe about $6,500. So the amount of the charitable deduction versus their adjusted gross income is 98%. Because remember, 10,000 of that was property taxes, the other deduction. The tax savings, so the reduction in the tax due is about 16% of the gift. So one thing that makes sense to do is come in and figure out, okay, even though I've made that full contribution this year, maybe I elect to take a portion of that contribution next year. Because what we're trying to do here is look at kind of maximizing the tax brackets. So assume we still do the same amount of charitable gift, but they have $302,500 of it carry over. So we deduct 50%, gets our taxable income down to $302,000. Tax due is $40,000. We've reduced the taxes by 50 from what we originally owed, and that tax offset is 23%. So if we get to the point where this person's going to retire next year and income's going to go down significantly, then maybe they go on and they claim the full deduction this year because tax rate next year will be 16% or less. If it looks like next year's going to be a better year, their taxable income's going to be higher, then maybe we make the election. We don't make the election to claim it this year, and we end up doing the rollover to next year.
All right, next scenario. We have retirees, married filing jointly, age 75. Most all of their income is portfolio income plus Social Security, pension, and they're getting required minimum distributions from the IRA. Property taxes are capped out at 10. Charitable contributions is at 15 a year, and this is what their base case posture looks like. They would pay federal tax at about $41,000, and it's important to note that their charitable contributions sits right at 5% of AGI. So, Perry, what do we do for these guys?
So in this case, we've got a couple that normally is doing some substantial gifts, but we've looked at maybe they'd like to they've got large charitable bequests and they'd like to see that cash put to work before they're gone, and see the benefits of it. So one thing we looked at is let's see what happens if we increase the charitable giving up to $190,000, brings their taxable income down to $90,500. Tax due, we have a little bit of capital gains tax. We've got some of that net investment income tax, so that gets them to about $2,700 worth of tax due. We've reduced the tax burden by 38%. The offset, the benefit of that tax deduction is about 23%, and what they were able to give away was 68% of their adjusted gross income. One other thing that we can look at is if instead of doing all of the gifts outright or out of their checking account or out of their brokerage account, there's two options this year with the IRA distributions. First, they don't have to take one, so maybe they don't take it, or B, maybe they do the qualified charitable contribution. So in this case, we're still going to give away $190,500 to charity. Of that, we're going to have them do $75,000 worth of cash, $70,000 worth of appreciated stock, and then $40,000 of a qualified charitable distribution out of the IRA. Now, there'll be more discussion on this in the webinar next week, but what that does for this couple is it brings their adjusted gross income below $250,000. So we've gotten to the point where there's that net investment income tax has gone away, and the total tax burden is $750. So, kind of the key to this is going to be doing a lot of planning at year end and figuring out how the math works best.
Right. Yeah, this is a great example, and credit Perry for really tweaking this a lot. We really worked on this one particularly because of the trying to work in a good example with the QCD, qualified charitable distribution. fact pattern, and the fact that this yields a 30.8% benefit to this couple with respect to the additional, charitable contributions that they're getting, and the reduction in taxes is pretty incredible. So definitely something to look at there. All right, our last scenario here. Another retiree couple, age 75, mostly, portfolio income, interest, qualified dividends, et cetera. A little more charitable minded, given $185 a year in cash. So the base case tax posture for them looks as follows. And we're throwing in here that part of their cash contributions are going straight to public charities, and then they have a donor advised fund or funds that they're given to, as well. So Perry, this is a real interesting one to go through. This next through, everybody pay attention.
So a couple of options. The first thing we did is say, all right, let's just reduce the capital gains tax down to, or excuse me, let's reduce the taxable income down to zero. So we do $150,000 worth of capital gains property, and then $450,000 of cash to charities, and then a donor advised fund for another $85,000. So that basically knocks out taxable income. But like we talked about before, you've still got that net investment income tax. And then the other thing, so we've reduced the tax bill by $74,000, about 15%. But one thing that's important to keep in mind, remember we talked about earlier, you've got a 0% capital gains tax on the first $80,000 basically if you're married, filing joint. So maybe it makes sense, instead of taking the full, instead of claiming all of that deduction this year, maybe we decide to defer a piece of it. And so what happens if instead of the itemized deductions being $694,000, we get it $615,000? So we basically, reduce the amount of contribution this year and then bump up next year's contributions by that $80,000. Gets us to right at $80,000 worth of taxable income. The income tax goes away, that net investment tax stays around. So you end up with $80,000 lower in contributions and the same tax answer. So in the case of this couple, it makes sense to split those gifts over a couple of years. And then, one other thing that might even be worth thinking about for them, we didn't want to overcomplicate things, is that if they did the qualified charitable distribution out of the IRA, then that would also reduce that net investment income tax by a few $1,000s as well.
Right.
So
yeah, so that's a good one.
It's a lot of moving parts.
Yes. Yeah, there's a lot. It's all these scenarios really demonstrate the need to get together with the right folks and your professionals and your advisors to do the planning. So just some key takeaways. I'm not going to go through all of these, but just some of the ones that are, obviously net investment income tax for some people is going to kind of act as an ultimate minimum tax. So don't think that just because you're zeroing out taxable income, no tax. Well, you have to do the math. You have to run the calculations to see if there's any other of these tax regimes that will come into play. The 0% tax bracket, as Barry mentioned, I think that's very key in planning for this. If you're not looking at that or have not encountered it before, balancing the funding for additional contributions against rate of savings, as we're seeing, it depends on what level of tax bracket you're in. Donating stock, finding you can still do that with the law. The law is not saying you have to only do cash. It's the stacking and finding the optimal mix that matters. The flexibility with election to take excess deductions in 20 or 2021 that'll be interesting to see how the IRS falls out on that and what that election looks like and what the capability is going to be for people who do planning. Do the math. Just simply do the math. You've got to get the right people involved and do the math and run these calculations now. I mean, it's you know, it's September, late September, you still have time to do this and make some moves before year end. With that, we'll cover off on a few retirement planning considerations and strategies. I'll flip it back to Perry. Perry, take it from here.
So I just want to hit a couple of quick high points on this. You know, this year, because of the ability to deduct basically 100% of your adjusted gross income, is a good time to look at possibly doing a Roth conversion. So if you've got a large traditional IRA out there, when money comes out, eventually you're going to owe ordinary income tax on it. If you decide I'd like to do an extra $100,000 worth of charitable contributions this year, but instead of trying to reduce what my tax rate is going to be now, I'm willing to pay the same amount of tax, but I'll convert $100,000 worth of traditional IRA to Roth. That deduction, the contribution you're making to the charity offsets that 100%. So there's no incremental tax to you this year. And then the Roth money continues to grow tax-free and eventually comes out tax-free as well. So that's worth looking at doing. And then also, real quick, we've got qualified charitable distributions. If you're somebody that's 70 or older and your charitable contributions, when you add up your charitable contributions, your mortgage interest, real estate taxes, and the like, if you're not able to itemize your deductions, this is the best way, using IRA distributions to make your charitable contributions, because that way it comes out tax-free and you still get the benefit. So you kind of get an extra deduction there. And then also for individuals that are making large gifts, it does make sense to look at possibly doing up to the first $100,000 a year worth of gifts out of the IRA, because it comes out completely tax-free. And then, you know, one last thing to think about, required minimum distributions, that's gone away this year. So you don't have to take a distribution out. It may be worth doing stock contributions instead of the IRAs and the QCDs, but definitely look at those qualified charitable distributions next year. So there's, like we said before, there's a lot of moving parts to look at. So hopefully everybody will be spending time with their advisors between now and year end. And we've got an election coming up, in case anybody hadn't heard. So there's just going to be that much more, you know, to throw in the mix as far as what the planning is. Oh, and then one final thing to think about: if you're 59 and a half or older and you've got your cash is tied up in retirement plans, you can take a distribution out of there this year. It'd be taxable, but you then turn around and make the charitable contribution. So if you're looking for a place to be able to make larger gifts, that's an option for you.
Thanks, Barry.
All right, thanks.
With that, I think, Ron, we're open for questions.
So, gentlemen, we fit a lot into that hour, and to our attendees, we hope that we have answered some questions, but we may have created some new ones. So we will invite you, first of all, to ask any question that you may have now in the Q&A. But we will also, our presenters have generously invited you to follow up with them directly. Their contact information and my contact information appears on the screen. So as part of the whole lesson of doing the math, remember to talk to your advisor. There's many, is it fair to say that there's a lot of options with these CARES Act provisions?
Absolutely.
So y'all, can I just ask, because in my own personal giving, I was trying to figure out where Mary and I fit in to your scenarios, and I have to admit it got my head spinning a little bit there. So can y'all just, if somebody's watching this and they are intrigued with the whole idea, what would be the best way to take the next step? I mean, I understand, you know, going to talk to your financial advisor, but other than that, how would you advise somebody to just try to get their head around this Because I can definitely see a scenario for somebody would say, oh, this is just too complicated. So what are your thoughts about that person who's thinking this is just too complicated?
I would say they need a next step. Nothing worse would be to get with your CPA and do a projection first, just a baseline projection for 2020 to see where they fall out, what they've given your date in terms of charitable contributions, and then let the CPA kind of run some numbers and kind of stress test it, kind of like what we did, and that's the only way you're going to really be able to see the impact of any tweaks or any incremental giving that someone is going to do. Otherwise, if they just kind of know or have a good feel, yeah, I'm going to give an extra 50 this year. I'm way below the limit anyway, but may inspire them to go that direction. But I would say first step, go with your CPA.
And I think the other thing they need to do is they need to figure out what they want to accomplish and how much they're looking to donate. Because if they come to us and say, I just want to give away everything, then the first answer is okay, let's step back. But if you've got a strategy in mind of, if you've got a final amount, then that gives us the ability to look at your situation and figure out what the most, which bucket do we give it out of, and how do we put everything together, and which year do you take the deduction? So yeah, if you come in with an idea about what you want to do, then that makes it easier as Eustis is pulling everything together.
So let me just keep following that, and it looks like we have a couple of other questions, but a person is inclined to want to be generous and make a gift. I mean, am I right in thinking that this is definitely the year where if you're even thinking about a bigger gift, this is the year to do it? Am I right about that, or next year would be just as good? What would y'all's answer to that be?
My simple answer would be yes. It sounds absolutely conceptually. It's the right year to maximize and optimize your gifts up to a certain level that exceed these thresholds. You still have to do the work, do the analysis, because anything, if there's anything in excess, it's a carryover that they can use for 5 years forward. So it's not lost if they do exceed the limitation or decide not to make the election. If we do have the flexibility to make the election or not make the election, we've still given them money in 2020, put it in the right hands where it belongs, and then make the election decide based on our circumstances when we file a return in 2021, whether we make the election or not.
And I think that's right. That flexibility is huge. So if you are thinking about, large, substantial gifts, then this is definitely the year to look at doing it, because you've got essentially until October 15th of next year to figure out, okay, do I take the deduction in 2020 or do I take it in 2021? So yeah, this is definitely the time to look at doing this.
All right.
In order to take advantage of these CARES Act provisions, the gift has to be made before December 31st of this year. Is that correct, Perry?
That's correct, in cash.
I got a question from the Q&A. What is your suggestion for how nonprofit organizations utilize this information and work with donors?
I would say, I did see that question come up. Good question. First, make sure your constituency knows about this. Either put it on your website, make sure it's fully displayed on your website, and start now kind of dripping information to your donors, to your base, and at least to educate and put it in their mind. Because I think now is the time when this all passed in the CARES Act in March. Everybody was thinking PPP loan forgiveness and other stimulus checks and whatnot, and this was sort of forgotten. Now it's wide open. So I would suggest back to that person, get engaged with your board and get engaged on social media.
So do you guys think most financial advisors out there understand this, or not?
Eustis, I'll let you hit that one.
I was gonna let you hit that one.
I mean, it sounds like I think you've got a mix. I think you've got some that are really involved with their clients and really involved in the planning and get it. And then I think that you have some that don't. It's like anything else.
So again, back to the question of from the charity standpoint, would y'all advise us and any other charity to really arm people with so the information that you've just given so that when they go to their financial advisor, they're saying, help me do this? Would that be a way to start the conversation?
I think so. Yes. Help me optimize my tax position this year and use these provisions. I want to use these provisions to maximize, optimize my charitable giving for this year. Then you bring in a financial advisor. This is what the portfolio looks like. This is what we have in cash or securities that can be sold, harvest gains, harvest losses, and plan from there.
Yeah. And one thing we try and do a lot is sit down with the client's CPA, especially at year end, and especially if they have a history of doing these large gifts, and figure out what is the best way to do it. And like you said, Dr. Morris, if this is a year that's kind of touched a nerve, then okay, how do we maximize it?
Yeah, we're almost out of time, but can I just finish with one last story about Church Health and why this is definitely the year that we need help. I mean, again, this is just from this morning, me seeing patients, a 44-year-old man who has been working at a gas station for all of his adult life. Has diabetes, has developed a problem with his shoulder, so he's having trouble working on cars. Early in the year, the job offered health insurance, but his boss, in order to keep him working, eliminated the benefits. He still has his job. He's making $15 an hour, but just has not felt like he had the means in order to go see the doctor for a variety of problems. And yet it had built up to the point where he felt desperate. And so came to us today, and look, everything that he has a problem with, from his diabetes to his shoulder, which might end up needing surgery. This is what Church Health does. But there are so many people out there right now, y'all, with that story. People who have helped make our lives better, and yet they are struggling mightily. Not to mention the depression that something like that makes. I mean, this man in his life has never thought of turning to ask for charity. So I had to dissuade him that was even what was happening here, that we were here to help him because he's making a difference in our community, and we need his kids to grow up strong and healthy. And so we will be that entire family's doctor until he's in a position where he doesn't need us anymore. But this is definitely why Church Health needs everybody to take this information seriously and see this year as the time to really support us in ways beyond what you've normally done, because the need is enormous, and as of right now, there doesn't seem to be an end to what we need to do.
We're at noon, so I'd like to close by just thanking Perry and Eustis for your expert advice here. We really appreciate your time. I'd also like to invite our attendees. We have a webinar next week regarding some areas of planned giving, some of which have been queued up today. So if you're interested in learning more about gifts from IRAs, gifts of appreciated assets, and the like, that will be covered in our webinar next week. And we'll also have a component of foundation giving. So Perry and Eustis, thanks for teeing some of these subjects up for next week as well. And thanks for coming out, everyone. Appreciate your time.
You're welcome. Enjoyed it. Thank you.
Thank you, guys.
Thanks, everybody.
Bye-bye.